Alrighty folks, time to react to a few videos here, a couple CNBC videos. This first one, strategists should be telling the prospects for return are increasing, says Josh Brown. Now, I'm going to listen to that. We're going to watch that together. And then we're going to watch this one together. This is not a great backdrop for a terrific bull market. And so we're going to listen to what they have to say there. I got Vix prepped there for a reason. And yeah, let's jump into this. Hope you guys enjoy it. As always, make sure to subscribe. And
everybody, Liz, to reset our expectations on this year for stocks?
Well, I think the market's done it for us already this year and re-rated a lot of the stocks that were driving those strong returns for the last 18 months. But I do think it's a good time to sit back and admit that this is not a good setup for economically sensitive areas of the market, at least in the near term. And what we're all sitting here wondering is, what's the breaking point, right? So when you look at where oil prices are, we sat back and thought about, all right, at what point do consumers actually hit that demand destruction level? And if we look at the amount that consumers are spending as a percentage of their overall spending on gas and energy, as of the end of January, it was 3.2%. The comfortable level that we can stay at is somewhere in the low fours. If we get above that level, that's usually where it breaks, which means that we have a little bit more room here for energy prices to go up. But if you just take how much gas prices have risen since the end of January until now, we're almost there. We're almost at that 4% level, and this starts to get worrisome. So either we hit a peak and we start to relax from here, or we keep going and it becomes a contraction picture.
And that's why there's all these like predictions now, like $200 oil. I saw one saying $300 oil. Per barrel, which right now we're at like 120 something. Those numbers are really huge, and obviously that has caused gas prices to massively go up more, and that's what leads a lot of people to think companies could miss EPS. Maybe we could go into recession. Maybe, if people have to pay $7 per gallon for, gas, at some point that just starts to hit consumers. They don't have as much money to spend other places, which kind of gets you into this kind of bad dominoes game, right?
So Josh Brown, they go on, Evercore does, and say they say a test of 36.
And that's all, at the end of the day, that's just guessing. It's a big guessing game when it comes to commodities and what's going to happen with those commodity prices in the short term. It's just so dependent upon so many different factors. It's
70, while not our base case, cannot be ruled out. But these targets also suggest that after this pain, you're going to revert back to some sort of gain. Now, you may not be as optimistic as 5,100 once was, but how do you feel about cutting price targets, resetting expectations? Forget the targets themselves, but just the idea of resetting our expectations for how we came into the year because of everything that's now going on, and the fact that it may persist for some time. And oh, by the way, we got to worry about the Fed too, not just Ukraine.
Just the whole concept of moving price targets after the market does what it does. Like, I feel like these people are experts in telling you what just happened. Is that worth anything? I'm not sure.
I know, that's why I say forget the targets. Exactly why I said forget the targets. Focus on the number. Focus on the idea. Focus on the idea.
Judge, I am. I'm not even talking about the specific target. If somebody's like 5,100 or 4,900, it doesn't make a difference. I'm referring, I guess, to this mentality that as markets fall, there's less opportunity, not more. Of course, that's not how it works, or at least it hasn't in the last 300 years. I'll let you know when that math changes. But this is when strategists should be telling people, okay, actually, the prospect for equity returns on a go-forward basis are increasing because now there's fear, now there's pessimism, now there is positioning where...
Exactly, and that's the most frustrating thing in the market is so many times I see is people just don't get this concept of like, when the market's lower, when stock prices are lower, that means the returns you are likely going to get over the coming years are much higher. And the higher stock prices are, the higher the market is, the lower likely returns will be over the coming years, right? It's like if I said... let's look at Amazon stock. Everybody knows Amazon stock, right? If you had an opportunity to either get Amazon today for $1,000 a share or $3,000 a share, what is the better pricing? Of course, it's $1,000 a share, right? Because your return you're going to get over the coming years is going to be much above. So the cheaper your stock price is, if it's the same exact company, it's a better return prospect over in future years, right? If I could give you Apple for 50% discount today for stock price, of course you'd say, well, my chance of great return in that stock just went up exponentially, right? That's the way this game works. But unfortunately, a lot of people don't see it that way, and it's frustrating because it's at the end of the day, it comes down to common sense. But not everybody, really gets the common sense part, and that's kind of the most frustrating thing about it, right?
Or getting to the point where maybe they're not long enough, right? That's actually what's taking place. I'm on the show every week for the last 8 weeks saying it's a bear market, it's a bear market. Now you have all the major averages below their 200-day, and worse than that, you have the 200 days or 10-month moving averages flattening out. It's as clear as a bell that we're in a statistical bear market for most stocks. If not for Apple and Microsoft.
There's no doubt we're in a bear market. The only question is, how long does bear market last? The NASDAQ as of yesterday was down over 20%. Russell down over 20%, and obviously the massive sentiment is super negative. Those are all the telltale signs of you're being in a bear market when you're down 20% plus on the indexes, and you're on top of that, everybody's negative, which the majority of folks are negative on the market, meaning they're bearish on the market when it comes to investors. So that's a telltale sign. So we're in a bear market right now. It's just a question is, how long does this bear market last? Does it last like a month? Does it last 3 months, 6 months, 9 months, 12 months? I think that's up for debate, right? But you can't debate if we're in a bear market. We're absolutely in a bear market.
Actual statistical bear market for the indices. But the point is now when you want to start getting pessimistic, we had a 19% sell-off in the NASDAQ, right? 12% of the S&P. Now you want to get pessimistic? It makes no sense to me. So ignore the price targets entirely. The rationale behind the price targets is interesting, but just focus on this idea: the lower the market goes, the more potential upside. It doesn't work the other way around, believe me.
Hey, Steve Weiss, it's bad when Tom Lee's putting out a note today that says stocks are, quote, in no man's land. And he's been suggesting that, we may not see a huge amount of downside, but he's been more optimistic than most. Now he says this: no man's land. So even the most bullish, it seems, are capitulating at least somewhat.
Yeah, well, when I was on the show on Friday, you asked me what would it take for me to get more constructive on the market, because I've been extremely negative since before the turn of the year. And I said, when people stop being optimistic, but I still think there's too much optimism out there. I think it's so misguided to refer to this as another geopolitical flare-up. In the past, the geopolitical flare-ups have had short-term impacts, very short-term, and it's generally just been related to a spike in crude, which over the following days, if not the next day, have declined back to more normal levels. This is really a global war. This is global economic war. And to Liz's point, I looked at some data today. The average, the median household income in the U.S. was $74,000, and as of the end of January for 2021, whereas the cost inflation.
I have a little different perspective on that. First off, I think the trade war was actually much more serious than what's going on with this Russia situation. When you talk about the Chinese-U.S. trade war that was going on there, that was something that, when you think about who's the biggest, who runs the world when it comes to the economy, it's the United States, right? Who's the number two? China. And we talk about, we really got into an economic war there for a while, and the trade war, the tariffs, all that stuff. That, to me, was a much bigger thing economically than actually this Russia situation, the sanctions on Russia and these sorts of things. The China situation was much, 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 much bigger, in my opinion. So, I'll just kind of push back against that, in my opinion.
Again, on a median level to the average household is $3,000. That puts you at 4%. So that, to me, is very, very real. And that 4% didn't come over a long-term period where you can adjust. It came as sticker shock. So my biggest concerns continue to be that you see estimates on individual companies continue to decline. We haven't seen enough of those. And the consumer. So the consumer drives it all. They're 70% of the economy. And we've seen the Michigan survey, consumer confidence, decline to lowest levels in 10 years. I think you'll see consumer spending decline. So it's hitting everywhere. And
the AAII, investor sentiment has been incredibly bearish, like the most bearish we've ever seen, or at least in a long, long time. I don't want to say that we've ever seen, but in a long, long time. And, a couple of weeks ago, for instance, on the 16th, that week ending, only 19% of those folks were actually bullish on the market. So I'll push back against this kind of narrative about people being too bullish on the market because we're just not seeing it in the pricing. As of, like I said, as of yesterday, NASDAQ is down over 20%, S&P 500 down over 20%. Everywhere I look, I see stocks down 40, 50, 60, 70, 80, 90%. So based upon sentiment and based upon pricing action, I would not call people bullish on the market right now. So I just push back against that.
Right now, we're just not really seeing it. Some of the stocks have reacted, but you take a look at the airlines. I mean, they're getting crushed. Only Alaska and Delta hedge. So they'll try and push those price increases on. I don't think they'll do it. I don't think they'll be able to do it, nor will others. So I continue to be negative on the market. Look, I'm not saying short the market here, even though on Friday after the show I got a little more negative into the weekend. What I'm saying is don't buy yet. It's not time to buy yet.
Hold on.
He says, don't buy yet. Okay. All right, let's watch this one. We got an all-female panel here. I appreciate that.
On the market.
Get into this.
Because there's still a lot of garbage and difficult times ahead of us. We have the Fed still entering a tightening cycle. I don't know if they'll reduce their balance sheet at the same rate that they were going to 3 weeks ago, but they might. Interest rates are rising. Geopolitically, things are really hard. We've had a spike in commodity prices, which they may come down or they may sustain for a long time.
Look at that, 72% of NASDAQ in bear market. 72%, Yeah, I definitely wouldn't call it a bullish market we're in, or a market when there's a lot of optimism when 72% of the NASDAQ's in bear market.
And we have valuations that aren't cheap yet. They're not extreme. I would have said around 22 times valuations were extreme, so now I'm feeling a little better, but I would still say valuations are stretched. This is not...
it depends on where you look in this market. Meta's trading at the cheapest valuations by a mile it's ever traded at. PayPal, the same exact situation. Amazon, same exact situation. Shopify, even stocks like Shopify, Netflix are trading at the cheapest valuation metrics they ever have. So I'm looking at a ton of these stocks that, I'm talking, those are just big, like super large cap companies, right? That the valuations have gotten the cheapest. If you're looking at their forward Ps, if you're looking at their price to sales ratios, many of these companies have never traded this cheap. So it depends on where you look. If you're looking at Apple and Microsoft, fair play. Yeah, maybe those ones aren't trading the cheapest. If you're looking at the energy sector, if you're looking at utilities, fair play. Those ones aren't necessarily trading like incredibly cheap. But when you go a little bit outside of that, you find out many of these stocks are trading by far and away the cheapest they've ever traded out in price to sales ratios and forward Ps and forward price to sales ratios. So I think that's something to think about.
Great backdrop for a really terrific, exciting bull market. It's just not. And I think it's messy, and I think it's going to be hard. So I used the word when I was on last week, and I think it's the right word.
And, she makes a point there that's not a great market to build a bull market on. But I will say, markets like this are actually what bull markets are built on, because you have this massive wall of worry that's filled with inflation, the Fed, Russia, oil prices, all that, right? Well, it's just a matter of time before those bricks start to get destroyed brick by brick by brick. And as you start to have that happen, the market starts to jump and jump and jump, and the indexes start flying high, right? And stocks start coming back strong. So the biggest question is, when does that happen? When does the bricks start getting destroyed one by one? But and Kathy Wood says this. She this is a quote from her. She says, the best bull markets are built on the wall of worry, right? And so that's something to think about. And when things start to turn, man, do they start to turn fast? It's just a question of when does it happen, right?
It's treacherous out there, and it will be treacherous for a while. 2022 is going to be a very hard year where there's hard work to be done. I also think that this will be an asynchronous correction.
71% of S&P 500 in correction. Wow.
I don't know, when you asked the question before, Scott, and you said, are we at a bottom and is it time to buy? I think, yeah, it's time to buy. But don't need to buy broadly. But I don't know that we're at a bottom either. And I think that those things are going to move asynchronously. So there will be stocks all along that you can pick off. As you know, a couple weeks ago, I bought Foot Locker and 3M. Great. The market pulled back and I was able to buy each of those. But I'm not broadly just piling in and saying, hey, the whole market's down. We can add to everything in the portfolio. So this is a time just to be cautious, sit back, be patient. You don't need to throw all your cash in. You can just breathe. One thing that's important, though, is in the very long term, I will always be bullish on equities. I will always believe that over the long term, the equity market will give you a positive return. So if you're fully invested, you don't also need to cash out right now. You can just be patient.
Bryn, somebody's buying. because we're positive across the board, and we're at the highs of the day now for stocks. So we've had a little bit of a rebound since we started in the last 8, 9 or so minutes. Now, to the question of, do we have more downside ahead? Are we at a
patience? She says, be patient. And, there's some truth to that, right? Buying strategically and not just going all in one day or something like that. And I agree with that. But what I will say is, you got to understand, the market can come back very, very rapidly. Let me show you something. So in terms of when the market flips, things can happen pretty rapidly, right? So for instance, you look at the NASDAQ, this is going into the Rona crash, right? It was topping out just below 10,000 essentially. In a matter of a few weeks, the NASDAQ was down to 6,600, just got absolutely decimated, right? And then a few months later, the NASDAQ's back to 10K again, right? And meanwhile, during this run up back, right? I mean, you had stocks that flew up 100%, 200%, 300%, right? If the indexes make that big of a jump in that short of an amount of time, you're going to have some stocks that double up, triple up, quadruple up in a matter of months, right? And so while I don't think we're going to have any sort of that type of snapback in this sort of market, I do think it's some food for thought where you got to understand these markets when they turn rapidly. You saw this in the 08, 09 recession. You saw this in the 2018 crash, right? Where, NASDAQ went from 8,000 plus to next thing you know, it was, low 6,000. And then in a matter of a few months later, it's back to 8,000 plus, right? And so in this situation, we were at 16,000 and some change. We've fallen rapidly to 13,000, 12,000 range, right? And so to imagine the market turns and all of a sudden in a few months from now, we're back at 16,000, that would not be abnormal at all. Okay, so this is just something to think about. Doesn't mean it's going to happen, but I think, you got to consider these things and how the market actually works. And, a lot of times people don't buy heavy enough and they're in a situation where they're like, dang, man, all those stocks were so cheap like 4 months ago. What happened? I'm like, why did we come back so fast? And it happens pretty rapidly. The falls happen rapidly, and the rises happen pretty rapidly.
So we can finally feel comfortable buying some stocks like Stephanie Link is, and some of the others may be as well. There are some notes regarding that today. Steve Suttmeyer, Bank of America, no true capitulation yet. Hasn't seen it. He says that favors more downside. Jonathan Krinsky, whose insights from a technical standpoint we like very much, says we're getting close, but we haven't had a full washout yet. Do we still need that? It's not like you get that every single time. And believe me, we have had some pretty sizable downdrafts. Are we close?
So that's an interesting comment there. If we look at like the VIX, for instance, today it's dropping down to about 34, which is still insanely high, by the way. So this goes all the way back like last 30 years. And yesterday the VIX was trading at 36, right? Over the past 30 years, count how many times the VIX was over 36. And it's not very many considering how many trading days have happened in the last 30 years. Okay, I was born in 1989. I'm 32. I feel like I've been around for a while. Let's just put it that way. The amount of trading days that have happened in that time, and you're not going to find the VIX trading over 36 that often. And so, given that, I would say that's somewhat of a capitulation market. When you're talking about VIX of 36 plus, you're in a somewhat of a capitulation market. Yeah, sure, you're not in a 08 type market, or sure, you're not in a March of 2020 type market. No way, right? But you got to understand, when the VIX is spiking that high, I don't want to say we're in a full washout mode, but that's pretty darn close. That's what I'll say about that.
We're close?
I think you actually do get that. I think we actually have had that 90% downtime every time, except when we had a sell-off in either 98 or 99. So I do think that technicals trump multiples right now. And what I mean by that, and we'll obviously if we hear from Jonathan later, but I think technical analysis to look at where the support level is. For the S&P right now, I think it's around 4,000.
She has a point there, and I hate technical analysis. I think everybody that watches my channel, usually, you guys all know that. I hate technical analysis with a passion, right? But what I will say is, in a market like this, right, no one cares about valuation right now. I went through a bunch of stocks earlier about that are trading at their cheapest price to sales ratio and forward Ps and forward price to sales ratio and all those sorts of things, right, that they've ever traded at. But in this sort of market, that doesn't matter. Your 3-year out, your 5-year out vision doesn't matter. The market doesn't care about that stuff right now. So in a market that is not judging you off of anything you're doing as far as that goes, right? What do you have to judge off of? I mean, at that point, the market's just looking at technical data, and it's frustrating, but she's actually got a point there.
We might be closer to 300 for the Qs, which would be representative of the NASDAQ 100, and I own, by the way. And so versus multiples. And when you look historically at current multiples and then project subsequent one-year returns, there's almost no correlation between that. So I'm not focused on whether the multiples are 19, 18, or 17, because it really has no predictive power over the next 1 year. I do think technicals, though, gives you a tradable entry point. And it seems, because we haven't had those big sell-offs, that big down day, that we could have more to come. I do think that...
I don't know why this random thought just crossed my head as I was watching this. I was just thinking about, there was some talk when Biden got in office that maybe they would try to raise corporate taxes, right? And corporate taxes try to get back up. Well, with all this going on with inflation and, companies and, the Russia situation, all this, right? I tell you, there's not going to be corporate tax hikes anytime soon. So I was just thinking about that, and I was like, that's actually really bullish for company earnings, because basically if corporate taxes were to go up, that hurts your EPS, right? So, something to think about there.
And looking out later on this year, where I have pause is that in Europe, the probabilities of Europe going into a recession have definitely ramped up. And as the U.S. has plenty of supply of natural gas, right now in Europe, Scott, natural gas is 13 times higher than in the U.S. Food prices globally are going higher, which hits the most vulnerable of people globally. And so I think GDP was already going to be decelerating because China was slowing down. This adds that in there. Now come back to the U.S. We have higher food prices. That's not going away. We have higher energy prices. That's not going away. And although energy prices compared to the 80s as a percent of U.S. consumers' budget isn't as high as it was, I do think that the market, the consumer is more vulnerable. And whether we have we'll call it a sentiment recession with consumers or an actual recession, I think that sentiment recession where people just don't feel like spending because they feel very uncomfortable.
Okay.
And then just finally, Scott, there are so many second, third, and fourth, and fifth order effects from this Russian invasion of Ukraine. And I don't know if the viewers saw, nickel is traditionally trades at about 20,000 per metric ton. It closed yesterday at 50,000. Last night, nickel was at 100,000. Why is that important? That goes into lithium batteries. That goes into all sorts of green technologies. So then how does that affect Tesla, GM, Ford? And so there's so much to actually to discern through that I'm still very cautious, because I don't think this is a traditional type of event where we cut countries off from the SWIFT system, et cetera. So I would still remain cautious.
All right. Yeah, I mean, she has a good point there about obviously commodities going insane, that hurting, the possibility of Europe going into recession. I think all those things are always on the table, right? It's very hard to predict exactly what's going to play out and how it's going to play out and those sorts of things, because you have so many different moving parts, and like you might have a negative here, but then you got a positive over here, right? From what I see in the real world, at least in Arizona, Vegas, spending looks strong. The economy looks strong. You can't even get a dang massage in this dang city, man. It's busy everywhere I go. Like everywhere I go, I don't care if it's a Topgolf or it's restaurants or it's a mall. Like, it doesn't matter where it is. It's packed, man. Target, it's like crazy busy everywhere. So, maybe that's just something going on the West Coast and we just have it like that, or maybe that's across the United States. I don't know. We'll see. All that has to transpire. But I think the Josh Brown point was the best point that was made in these videos, in my personal opinion, about when the market goes lower, your future returns just went up. That's exactly what happens every single time in the market for the past 100+ years. And that's just the way it works. And so I thought that was a really good point. It's common sense, but man, it doesn't hit a lot of folks, and it's kind of frustrating. Everybody gets so tied up into the short-term stuff that's happening and things like that. So anyways, guys, hope you enjoyed this video. As always, much love. Appreciate you. Let me know if you got any comments on anything we watched there. I'd love to hear from you guys in the comment section. Don't forget to get some basically free money from Moomoo. Basically right now, if you check out pinned comment down there, set up a Moomoo account and deposit any amount of money, literally any amount of money. They got one free stock worth $3 to $3,500, one free stock worth $9 to $3,500, plus one free share of NEO with any deposit. It's pretty flippin' flapjack and amazing. Have a great day.